We've seen pressure on stocks today after US President Donald Trump threatened to slap a 10% extra tariff on imports from 8 European countries because they oppose having America take control of Greenland. Let's get more on this from Kevin Headland, co-chief investment strategist at Manulife Investments. Kevin, thank you very much for joining us this morning.
Thanks for having me.
I know, obviously, this is a moving, fast, changing situation, but what broad guidelines can you offer here, or what's jumping out for you in the current investment landscape? I'm talking about Greenland right now and the tensions.
You know, when we look over the years, we're always going to see some geopolitical risk that happens throughout the year. Of course, this year starting off quite heightened in geopolitical risk creates some choppiness and volatility around the equity markets. This is where perhaps flight to quality makes a lot of sense, where you look at companies that are perhaps insulated a bit from geopolitical risk and globally, perhaps insulated against tariffs. What you want to see here, gold has done well as a flight to safety. This could actually be positive tailwind for TSX equities, given how we have a large position in gold in the TSX. So when you look at geopolitical risk, I think it's an idea where we want to perhaps look at rebalancing our situation, not taking undue risk, and understanding that these tend to be more disruptive than destructive over longer term.
That's good. Disruptive rather than destructive. I like that. That's neat. So our market, the Toronto Stock Exchange, a total return of over 30% last year. But you notice it was relatively narrow. Gold, banks, and Shopify accounted for about 2/3 of the gain.
Correct. That's exactly what happened. We had banks rallying quite strongly, of course, gold and many materials as well. If you add the material sector as a total, you're up to close to 80% of the TSX was due to those three factors. There is potential for further support for the TSX higher. I just don't think we can achieve the same type of results. It would be great if we got back-to-back 30+% returns. I don't think it's quite possible. That doesn't mean we are negative on the TSX. We're constructive. And I think banks could do well, again, given some of the support metrics that the Bank of Canada put in over the last year to 18 months, going back to October's last rate cut. It tends to take about 12 to 18 months for rate policy changes to have an effect on the broad economy. So there is still some stimulus there. And then, of course, we have the budget and the federal government looking at further stimulating the economy, which also support banks. And gold is another one where we see continued legs higher. It doesn't go as high as it was last year, not necessarily. But again, I don't think there's any reason why gold should turn back, given the support metrics that we're founded upon over the last year or so. Global governments and central banks redeploying their assets or diversifying assets from the US dollar towards gold, as well as, again, the flight to safety, geopolitical risk helps gold as well. So there are definitely support metrics for underlying TSX moves higher this year.
It doesn't look like there were any big surprises on the inflation front today. The number was distorted by those tax breaks that the federal government gave us on kids' toys and alcohol and stuff at the end of 2024. What is your read? Do you think the Bank of Canada is it conceivable they'd cut again in the near future?
The point you talk about, the distortion, is the big point, because if you look just at the numbers, you'd say, oh, inflation is stickier. Perhaps the Bank of Canada is looking at raising rates to combat inflation. We don't think that's the case at all. That distortion is important to understand the base effects. We have to understand that it's not just about the headlines, understanding why those numbers moved. So that's important from there. I don't think the bank necessarily cuts rates this year unless we get a surprise here. It's not about inflation. It'd be more about an economic weakness, unemployment shock, something there where the bank kind of feels they need to cut rates to stimulate the economy. They're at neutral right now. I think they're quite happy where they are. Inflation's coming down towards their target. If you look at some of the other measures they look at, it's actually below their target, 2%. So they're quite happy where they are now. It'd be more about a reaction to a negative economic shock, more so than an inflation story right now.
Are you interested in energy? What you and your colleagues, are you overweight, underweight, or what are you doing about oil and gas stocks?
Right now, oil and gas, of course, you look across it, are you going to be investing in the pipelines, energy producers? Where on the oil and gas do you want to look at? Valuation as a sector base is actually not as attractive as many might think. It is fairly valued on a trailing P basis and a forward P basis. Of course, oil is stuck at that $60 level, as you mentioned earlier. That is, somewhere where we Canadian energy producers would love to see oil a bit higher. There's still, of course, some uncertainty around tariffs and Venezuela oil and how that fits with demand for our oil in the future. So it's one where we're looking at very closely, understanding the individual companies and how we might be able to take advantage. But it's not something where we just want to say we're bullish on the energy sector just yet. It's more about picking our spots and taking advantage of where we can.
When you talk to your colleagues and those who face or client-facing, to use the jargon, frontline advisors, et cetera, what are they hearing from your customers, from investors?
I think investors are quite happy. Of course, you look at open their statements now from 2025, very strong returns. Of course, many have said we're not going to be able to repeat the U.S. equity market returns we had in the previous 2 years. This year was kind of a handoff to the TSX as well as international stocks. So I think there's a lot of excitement around their investments right now. We are being cautioning that perhaps this is a great year to just dial back the risk a little bit, understand that this is a very strong market, but strong markets don't always continue to the same degree. But look at the risks as well. People are calling a bubble in AI. We don't necessarily see that, but perhaps we want to be a bit more risk controlled or risk managed right now in our investments.
And AI, broadly speaking, are you wary of a sell-off, perhaps sparked by OpenAI, for example, running into a debt crisis?
I think it's really important to understand the individual companies in AI and look at their earnings announcements this year, as well as their guidance. Spending was materially higher last year in AI. You saw a couple of companies that rallied on the announcement of spending and then pulled back afterwards. So it's important to understand the individual companies here. AI is likely a long-term here to stay. The type of enhancements and productivity enhancements that we're seeing from AI is really important. But understanding that those businesses are spending and perhaps too much on debt, that could be an issue longer term. Short term, not necessarily an issue, but it's definitely something to watch out to make sure that those companies are growing as a result of their spending, growing the revenue, growing the earnings. It's not just about a debt spiral, shall we say.
We'd better jump. Kevin, thank you very much indeed for kicking off the show this Monday. Stay warm. Kevin Headland, Co-Chief Investment Strategist at Manulife Investments.